The American dream of homeownership is unraveling fast in 2025. Once thriving housing markets are now hemorrhaging equity, like water bursting through a cracked dam. Families who purchased at the height of the market are waking up to find $70,000 to $150,000 wiped from their home's value, seemingly overnight. Across the suburbs, for sale signs stand like forgotten relics, weathered and ignored. Meanwhile, insurance costs are skyrocketing, property taxes are tightening their grip, and foreclosure rates are climbing at a pace that feels like the 2008 crisis, only turbocharged. This isn't a gentle market correction, it's a housing bloodbath. So let's break down the 10 worst cities to buy a home in this year. Number 10, Fort Worth, Texas. Not long ago, Fort Worth symbolized the promise of Texas growth, affordable homes, new development, and rising values. But in 2025, that promise is crumbling into what feels more like a financial trap disguised as a housing opportunity. Back in 2023, the average home in Fort Worth was priced around $360,000. Fast forward to today, and many of those same listings have dropped closer to $300,000 or even lower. That's a brutal 17% decline in under 2 years, enough to erase tens of thousands of dollars in home equity for recent buyers. The shift in inventory is even more alarming. The number of homes on the market has surged by nearly 45% compared to last year. And instead of being snatched up in frenzied bidding wars, properties are now sitting stagnant for 2 to 3 months. With mortgage rates hovering above 7%, affordability has taken a major hit. And new construction, what was once a booming sector, is now littered with stalled projects and unfinished neighborhoods. Builders are offering $30,000 to $50,000 price cuts to offload units. But even steep discounts aren't enough to attract buyers anymore. Then there's the tax burden. Tarrant County ranks among the priciest in Texas for property taxes. A modest $350,000 home can come with a yearly tax bill exceeding $7,000. Factor in soaring insurance rates, especially in areas vulnerable to severe weather, and monthly housing costs have spiked by $500 to $700 since just a few years ago. Families who stretched beyond their limits during the housing frenzy are quietly putting their homes back on the market, hoping to escape before values dip further. Fort Worth isn't gently cooling off, it's hemorrhaging. And if market conditions worsen, it could end up as one of the sharpest cautionary tales in Texas real estate history. Number 9, Sacramento, California. Once hailed as the affordable alternative to San Francisco's madness, Sacramento in 2025 is starting to feel more like a money pit with no bottom. What was supposed to be a financial refuge has quickly turned into a nightmare for thousands of homeowners. Just 3 years ago, the typical home in Sacramento was priced around $525,000. Today, sellers are chopping prices down to the low $440,000s. That's a staggering loss of nearly $85,000 in value, roughly a 16% drop, leaving many recent buyers deep underwater with no easy way out. People who stretched their finances to escape the Bay Area's sky-high costs are now realizing Sacramento wasn't the sanctuary they hoped for. The market has flipped entirely. Active listings are up 38% from last year, and homes are sitting unsold for an average of 70 days, an eternity compared to the one-week sprints of 2021. Then come the hidden costs. Property taxes in Sacramento are no joke, adding close to $5,000 annually for the average homeowner. And insurance? That's another beast. With wildfire risk creeping closer from nearby counties, premiums have surged by over 30%, pushing monthly payments into the $3,000 to $3,200 range, up from just $2,200 a few years ago. The culprit? Mortgage rates hovering dangerously close to 7%. Buyer activity has collapsed. Investors, who once made up a quarter of all purchases in the region, have all but disappeared. The wave of remote workers who helped inflate the market during the pandemic? Many are quietly packing up and moving on. What's left behind are quiet streets lined with for sale signs and fading hope. Even the rental market is under pressure. Average rents have stalled around $1,700, but landlords are dealing with escalating expenses, making profitability harder and harder to maintain. The bottom line, Sacramento's so-called housing boom has fizzled out. What once looked like a solid bet in California's capital is quickly unraveling into one of the sharpest corrections in the state. For many, the dream of owning a home here hasn't just dimmed, it's completely disappeared. Number 8. Jacksonville, Florida. Once promoted as Florida's best-kept secret, Jacksonville in 2025 feels more like a cautionary tale wrapped in palm trees and broken promises. Back in 2023, the median home price was inching toward $350,000. Fast forward to today, and those values have plunged into the $290,000 to $300,000 range, a brutal 18% drop. For homeowners, that translates into tens of thousands in equity disappearing almost overnight. But the bigger problem? Oversupply. Jacksonville's building boom from 2020 to 2023 went into overdrive, flooding the city with newly constructed homes. Now, many of those sparkling subdivisions sit eerily quiet, draped in price-reduced banners. Builders are slashing $25,000 to $40,000 off asking prices just to get some interest. Even so, housing inventory has ballooned to over 6.5 months' worth of supply, well into buyer's market territory. And then there's insurance, the hidden wrecking ball. With major hurricanes pushing insurers to abandon Florida, premiums have gone off the rails. What used to cost homeowners around $2,500 annually is now soaring past $5,000, and in some cases, even hitting $6,000. Add property taxes that average $3,500 on a mid-range home, and monthly housing expenses are spiraling out of control. In 2021, a typical buyer might have budgeted around $1,800 per month. In 2025, that same house could now cost them upwards of $2,800 to $3,000 monthly, completely shattering affordability for many families. Deals are collapsing. Closings are being canceled. Investors are getting hit hard, too. Rental income has flatlined, with average rent stuck around $1,600. Meanwhile, maintenance, taxes, and insurance costs continue to climb. Many landlords who banked on big returns are now bleeding cash, and a growing number are offloading properties, sometimes at a loss, just to cut their exposure. Foreclosure activity is already creeping up, with filings jumping nearly 20% since early 2024. It's the clearest warning yet that Jacksonville's market is in real trouble. The city's growth story has taken a sharp detour. Once seen as an emerging hotspot, Jacksonville is now facing a perfect storm of price drops, unaffordable insurance, and buyer fatigue. The dream has soured, and fast. Number 7. West Palm Beach, Florida. Once the crown jewel of Florida's coastal living, West Palm Beach in 2025 is quickly shifting from luxury hotspot to housing war zone, and sellers are losing the battle. Back in 2022, the median home price here skyrocketed past $480,000, fueled by an influx of out-of-state buyers and big-money investors. But now, those prices have tumbled into the $400,000 to $410,000 range. That's a painful drop of around $70,000 in just 2 years, about 15%, and it's leaving homeowners shaken and equity disappearing. The most jarring shift, though, is in housing supply. West Palm now has nearly 9.5 months of available inventory, an enormous jump from the under 2-month levels during the peak mania of 2021. Homes that once sparked bidding wars and sold within days are now lingering on the market for 80 days or more. That kind of stagnation is pushing sellers to offer steep price cuts just to get noticed. Condo owners are especially feeling the heat. Many buildings have raised HOA fees to over $1,000 a month, an added burden that's crushing affordability and scaring away buyers who once saw condos as the easy entry into the market. And then there's Florida's growing insurance nightmare. Annual premiums that used to hover around $3,500 are now pushing $7,000 or even $8,000 for modest homes near the coast. Property taxes aren't helping either, with the average bill adding another $5,500 per year. Altogether, monthly ownership costs that were once manageable at $2,200 have exploded to between $3,300 and $3,600. For many, especially retirees who plan to stretch their budgets in paradise, that math simply doesn't work anymore. The rental market isn't offering much of a safety net either. Average rents are stuck around $2,200, meaning landlords are struggling to cover their ballooning expenses, many now operating at a loss. Even more alarming? Foreclosure filings in Palm Beach County have jumped 22% in just the past year, a chilling reminder of the early stages of the 2008 meltdown. What was once a glitzy Florida dream has turned into a financial nightmare. West Palm Beach isn't just cooling, it's cracking. The high-end market has lost its shine, and in its place is a housing correction that's growing harder to ignore with every passing month. Number 6. Houston, Texas. Houston used to pride itself on being one of the most affordable big cities in America. But in 2025, that reputation is unraveling fast. Back in 2022, the median home price climbed to around $345,000. Fast forward to today, and those same homes are struggling to fetch even $295,000, sometimes barely breaking $300,000. That's a painful 15% drop, erasing billions of dollars in homeowner equity across the metro area. The bigger issue? Supply. The housing market is absolutely flooded. Active listings have surged 42% year over year, with more than 30,000 homes now sitting unsold. Builders who rushed to meet pandemic-era demand are now paying the price. New subdivisions on the outskirts of town are ghost towns. Developers are chopping $20,000 to $50,000 off asking prices. Yet properties are still sitting on the market for 75 to 90 days with barely a nibble. Then there's the tax problem. Houston's property tax rate is among the highest in the U.S., hovering around 2.1%. On a $300,000 home, that's more than $6,000 a year just in taxes. Add in the skyrocketing cost of insurance, especially flood coverage, and the numbers get even worse. What used to cost $1,200 annually in flood insurance has now jumped to $3,500 or even $4,000, thanks to updated FEMA risk assessments. Combine those expenses with today's mortgage rates, and monthly payments that were once about $1,700 have ballooned to $2,600 or more. For many buyers, that price jump is simply out of reach. Investors aren't escaping the squeeze either. Rental income is flatlining. Most Houston rentals are bringing in around $1,600 to $1,700 a month. That's not nearly enough to cover inflated costs, and it's pushing some landlords into the red. Foreclosures in Harris County are rising too, up nearly 18% since 2024. Delinquency rates are trending higher, signaling that more distress could be on the horizon. Houston's famous motto, "Everything's bigger in Texas," now applies to the size of its housing correction. From shrinking home values to exploding monthly costs, the city is facing a harsh reality. Not even the energy capital of the U.S. is safe from a full-blown real estate shakeup. Number 5. Tampa, Florida. Tampa was once the crown jewel of Florida's housing boom during the pandemic, but by 2025, it's looking more like a cautionary tale than a success story. Just a couple of years ago, home prices here were pushing close to $410,000. Today, those same properties are selling for between $350,000 and $360,000. That's a steep 12% to 15% drop, enough to wipe out any equity for recent buyers who put down just 10%. In other words, if you bought at the peak, you're already underwater. The flood of listings is only making things worse. Tampa now has over 8 months' worth of housing inventory on the market, a dramatic shift from 2021 when there was barely enough to cover 6 weeks. Active listings have jumped nearly 48% year over year, leaving thousands of homes sitting unsold across Hillsborough and Pinellas counties. Properties that used to attract offers within 10 days are now lingering for 2 to 3 months, often with big red price-reduced signs out front. Home builders are scrambling, slashing $30,000 to $50,000 off new construction prices just to stay in the game. But even those steep discounts aren't enough to lure buyers back in. People are hesitating, and for good reason. Owning a home in Tampa has gotten significantly more expensive. Property taxes on a $350,000 house now hover around $4,800 per year. Add in hurricane-related insurance premiums, now ballooning to $5,500 or even $7,000 per year, and total monthly ownership costs are approaching $2,800 to $3,200. That's a 40% jump from what buyers were paying just a few years ago. For retirees and fixed-income households, that kind of increase is a deal breaker. Many are backing out or selling early, unable to keep up with the mounting bills. And if you're thinking of renting instead, that's no escape. Average rents are stuck around $2,000 a month, while landlords face expenses that keep climbing, making it tough to stay profitable. Investor demand, once a massive force in Tampa's market, has all but dried up. Flippers and short-term rental owners who once rushed in are now desperately trying to get out, often at a loss. The warning signs are everywhere. Foreclosures are up 19% compared to last year, and mortgage delinquencies are rising. What was once a Gulf Coast dream is turning into one of Florida's sharpest housing corrections. For anyone looking to buy in Tampa in 2025, this isn't a sunny deal. It's a storm cloud in disguise. Number 4. Austin, Texas. Austin was once the poster child for unstoppable growth in America. Tech-driven, fast-paced, and flush with promise. But by 2025, that promise is unraveling, and Austin is becoming the blueprint for how a hot housing market can turn ice cold. Back in 2022, the median home price soared past $550,000, fueled by a tech boom and waves of new residents. Fast forward to today, and prices have plummeted into the $470,000 range. That's a 15% drop, tens of thousands in lost equity for anyone who bought at the peak. What's behind the fall? Oversupply. Developers went full throttle during the boom, breaking ground on thousands of new homes and condos. Now, that building spree has left Austin buried in listings. Active inventory has surged nearly 50% in just a year, and the metro area is now sitting on nearly 7 months' worth of supply, well past a healthy market threshold. Homes that once sparked bidding wars are now collecting dust. The average listing now lingers on the market for 80 to 100 days. To move inventory, sellers are slashing prices by $30,000, $50,000, even $60,000 in some neighborhoods. But the damage doesn't stop there. The cost of simply owning a home in Austin is crushing budgets. Property taxes in Travis County remain among the highest in the state, with effective rates averaging around 2.2%. On a $470,000 home, that's over $10,000 a year just in taxes. Throw in insurance costs nearing $3,000 and a 7% mortgage rate, and monthly payments are now topping $3,500. That's a huge leap from the $2,400 monthly average just 3 years ago, a 45% jump, with no matching wage growth to support it. Investors, who once drove nearly a third of all home purchases in Austin, are now heading for the exits. With rental income stuck between $1,900 and $2,000 per month, landlords can't cover their costs, let alone turn a profit. Flippers are facing losses, and long-term holders are offloading properties before they sink further underwater. Even the tech crowd, Austin's economic backbone, is feeling the strain. Layoffs in the industry are cutting deep, reducing both the demand for homes and the incomes needed to afford them. Foreclosures in the region have spiked by nearly 25% year over year, and distressed properties are starting to dominate the listings. Austin's real estate market, once a model of success, is now a warning shot. When affordability tanks, inventory explodes, and costs spiral upward, even America's most hyped housing market can fall hard and fast. Number 3. Stockton, California. Stockton has always ridden the wild ups and downs of California's housing roller coaster, and in 2025, it's on another steep drop. After brushing against a $495,000 median home price back in 2022, values have since fallen sharply, now landing between $420,000 and $430,000. That's a gut punch of about $70,000 lost in equity, more than 14% shaved off in just a few short years. The shift isn't subtle, it's everywhere. Active listings have surged over 40% year over year, and the homes that once flew off the market in less than 2 weeks are now sitting for nearly 3 months. In fact, more than a third of all listings are marked with price reductions, and desperate sellers are even offering steep concessions, like footing $10,000 in closing costs, just to seal the deal. But it's the locals who are feeling the tightest squeeze. Even with San Joaquin County's relatively modest 1.1% property tax rate, owning a median-priced home still means shelling out close to $4,800 annually. And insurance. once a manageable expense, is now soaring due to Stockton's exposure to both flood zones and wildfire threats. Premiums are climbing past $2,500 a year. For those who bought in 2021, monthly payments that once hovered around $2,200 have now ballooned to roughly $3,200. The culprit? Sky-high mortgage rates and inflated costs across the board. Investors who once saw Stockton as an affordable alternative to the Bay Area are pulling back quickly. Rental returns have nosedived. Average rents around $1,700 no longer cover the bloated costs of ownership. Cash flow is drying up, and investor confidence is evaporating. Even more alarming, foreclosure activity is back on the rise, up nearly 18% year over year. It's a chilling reminder of Stockton's dark chapter in 2012, when it made headlines as one of the first major cities in the U.S. to go bankrupt during the post-recession housing crash. Today, it feels like déjà vu. Stockton, once hyped as an underrated gem for California buyers, is once again heading down a familiar and dangerous path, where rising debt, falling prices, and fading optimism collide. What was billed as a bargain is quickly becoming another cautionary tale in California's housing saga. Number 2. Oakland, California. Oakland used to be the Bay Area's best-kept secret, a more affordable gateway compared to San Francisco. But by 2025, that narrative has flipped on its head. What was once a value play is now a market in freefall. Back in 2022, the median home price topped $820,000. Fast forward to today, and sellers are struggling to move homes priced between $700,000 and $710,000, a jaw-dropping $110,000 drop in value. That's a 13% loss in just a couple of years, wiping out equity and punching a hole in household finances. And the listings? They've exploded. Alameda County inventory has jumped by more than 50% year over year. Homes that would have triggered bidding wars just a few years ago are now sitting for over 3 months with no offers. Nearly 40% of sellers have already dropped their asking prices, and high-end homes are taking some of the biggest hits, some slashed by as much as $200,000. The cost of owning in Oakland is becoming unsustainable, with California's hefty property taxes and soaring insurance premiums, especially in areas prone to crime or wildfire risk. A $700,000 home now racks up close to $8,000 per year in taxes alone. Insurance can add another $3,500 or more on top of that. Combine those with 2025 mortgage rates, and monthly payments have climbed to between $4,700 and $5,000. That's a massive leap from just a few years ago when $3,200 a month was typical. Rentals aren't offering a safety net either. The average rent in Oakland hovers around $2,500, far short of what it takes to cover rising ownership expenses. Landlords are feeling the pressure. Many are unloading properties, and vacancy rates in multifamily buildings are trending upward. On top of that, lingering legal risks and financial burdens from the pandemic-era eviction moratorium are driving even more landlords out of the market. Foreclosure filings are also creeping back up nearly 20% since 2024, another red flag that Oakland's housing market is tilting into crisis mode. Once considered the budget-friendly alternative to its glitzier neighbor across the bay, Oakland has lost its edge. Affordability is gone, investor confidence is crumbling, and local buyers are priced out. Instead of being a stepping stone into the Bay Area, Oakland is shaping up to be one of California's most exposed markets, a city teetering on the brink of a full-scale correction that could ripple across the entire region. Number 1. Cape Coral, Florida. Cape Coral was once the shining example of Florida's housing boom, an up-and-coming paradise fueled by sunshine, investor hype, and pandemic-era migration. But in 2025, the dream has turned into a disaster. This Gulf Coast city has gone from hot spot to housing collapse, and fast. Just a few years ago, the median home price in Cape Coral soared close to $430,000. Today, that number has plunged to around $360,000, erasing nearly $70,000 in home value. That's a steep 16% drop, and it's left thousands of homeowners with mortgages worth more than their properties. They're trapped in homes they can't sell without taking a major financial hit. What's worse? The inventory flood. Cape Coral now has over 11 months' worth of available homes, more than any other Florida city. That's a stunning reversal from the buying frenzy of 2021 when properties were vanishing in just over a week. Now, they're sitting for more than 100 days, often after 2 or 3 rounds of price reductions. In fact, nearly half of all listings are showing multiple markdowns. Builders, who overextended during the boom, are now offering discounts of $40,000 to $60,000, tossing in free upgrades, and still struggling to attract buyers. But the biggest blow is the cost of insurance. After the destruction from Hurricane Ian and the mounting risk of future storms, annual home insurance premiums have exploded. What once cost $3,000 is now easily pushing past $8,000. Some policies are even hitting the $10,000 mark. And that's just insurance. Throw in another $5,000 per year in property taxes, and the total monthly cost of owning a typical home in Cape Coral has jumped to between $3,200 and $3,600. That's nearly double what it was just 3 years ago. For many families, paradise has become a money pit they can't afford to maintain. Investors, too, are feeling the pain. Average rents are sitting around $2,100 per month, nowhere near enough to cover skyrocketing expenses. The math just doesn't work anymore, and many landlords are walking away. Foreclosure filings in Lee County have already spiked by 25% in the past year, a flashing red light that this market is in serious trouble. Cape Coral isn't simply cooling down, it's buckling under the weight of its own boom. The city once hailed as the jewel of Florida's housing surge is now the epicenter of the nation's biggest real estate meltdown in 2025. For buyers, it's a financial trap disguised as a deal. And for homeowners already inside, it's a slow, relentless storm that's washing away any hope of stability.